What is happening to crypto? Something clearly changed in the crypto market after October 10th? Let me explain. The crypto collapse. On October 6th, just 45 days ago, Bitcoin hit a record high of $126,272, worth $2.5 trillion. Then, something mechanical seems to have shifted on October 10th, after President Trump threatened 100% tariffs on China. Not only did this lead to the record $19.2 billion liquidation, but Bitcoin never truly recovered. Even when the October 30th trade deal was reached between the U.S. and China, liquidation pressures only worsened. Then, since November 10th, Bitcoin has moved in a literal straight line lower with average daily liquidations nearing $1 billion. Throughout the course of this 45-day bear market, crypto has seen little to no bearish fundamental developments. We continue to believe this is a mechanical bear market driven by excessive levels of leverage and sporadic liquidations. And the data supports it. On that single day, the market saw the largest liquidation event in crypto history, nearly $20 billion wiped out in less than 24 hours. When we add everything from October 1st to today, the total liquidation figure crosses $41 billion, which is an unusually high number for a period without major macro shocks, protocol failures, exchange collapses, or black swan headlines. What makes this even more unusual is that equities recovered, the S&P 500 made new highs, and Nvidia delivered strong earnings, yet crypto never stabilized. There has been no meaningful bounce, no relief rally, and no rotation. The market has moved in a straight down line. Forced selling, minor pauses, and more selling. If you look at the daily liquidation data, the pattern is consistent. Every attempt at recovery gets taken out by another wave of long liquidations. This kind of repeated behavior usually points toward one of three possibilities: a major entity unwinding positions, structural deleveraging inside large trading firms, or a series of systematic liquidity gaps triggered by thin order books. But the core point is that none of this has been officially confirmed. Despite the scale of the event, there's been no clear explanation from any market participant, no statement from large funds, and no evidence released showing what started the chain reaction. The strange part is that nothing in the macro environment on October 10th justified a liquidation wave of this magnitude. There was no ETF rejection or approval, no regulatory shock, no significant economic data, and no on-chain failure. Yet the sell-off created a structural shift in market behavior that has continued for 45 days. Traders were wiped out, open interest collapsed, and liquidity thinned across major pairs. Even now, the market continues to respond to small moves with outsized liquidations. This suggests that the initial event on October 10th did more damage beneath the surface than the market has understood. After such a large liquidation event, markets typically retrace or consolidate to rebalance positions. But we've had none of that. Instead, the selling has looked systematic and controlled, almost as if a single large entity or a small group is still in the process of reducing exposure. That is the part that the industry still has no clarity on. Billions were liquidated, liquidity conditions changed, retail was heavily impacted, and yet we still do not know who absorbed the losses or who benefited from the unwind. With over $41 billion liquidated since October 1st and $20 billion in one day, the market deserves transparency about what led to this sustained breakdown in market structure. And this is exactly where the Digital Asset Market Clarity Act matters. Because when $41 billion gets liquidated in 6 weeks with no confirmed trigger, the real issue is the lack of clear rules around market behavior. The Clarity Act directly targets the loopholes that allow this kind of unexplained move, bans wash trading, gives the CFTC real-time monitoring to flag abuse, criminalizes spoofing and front-running, requires proof of reserves and monthly audits for all U.S.-facing exchanges. If these standards were active today, we would at least know who was behind the October 10th liquidation wave and what actually triggered it. The market doesn't just need stability, it needs clarity. 40Y government bond yield has surged to a record 3.77%. It just hit a record high of 3.732. Since 2008, it has been under 1%, even near 0.5%. But since 2023, it's rocketed straight up, doubling from 1.8% to now over 3.7%. Yields rise when a country borrows more and bond prices fall. So, investors demand higher interest to lend money. Japan had super low interest rates, basically 0%. This made borrowing Japanese yen almost free. Investors borrowed yen cheaply, swapped it for dollars, and bought stuff like US stocks, crypto, or other investments that grow fast. They made easy profits because the loans cost nothing and the investments went up. The yen carry trade pumped up global markets for years. Now Japan is seeing inflation rise, so they're hiking interest rates. The 40-year Japanese bond yield just hit over 3.3%, a big jump after decades of low rates. Borrowing yen now costs real money, not free anymore. Now, investors can't afford the higher loan costs. They rush to close trades, sell US stocks/crypto, swap dollars back to yen, and pay off loans. In short, cheap yen fueled a global party. Japan ended the free drinks. Now everyone's heading for the exit, and markets are crashing. It's like a giant margin call on the world economy. MSCI, which stands for Morgan Stanley Capital International, what they do is creates and maintains stock market indexes. MSCI's indexes are used by investors, especially in passive funds like ETFs. If a company gets added or removed from an MSCI index, it can lead to billions of dollars flowing in or out as funds adjust to match the index. MSCI is reviewing whether to kick strategy out of its major indexes because the company holds way too much Bitcoin, about 77% of its assets. MSCI's proposed rule says companies where digital assets like Bitcoin make up more than 50% of total assets should be treated like investment funds rather than operating companies. Funds aren't eligible for these stock indexes, so removal could force passive investors to sell strategy stock, potentially causing $2.8 billion in outflows just from MSCI tracking funds and up to $9 to $11 billion if other indexes follow. Saylor is saying, MSCI might boot us, but we're pioneers building the future of money with Bitcoin, not some boring fund. Our stock might dip from sales, but our vision stays the same. The decision is expected by January 15th, 2026, and strategy stock has already dropped 40% in the past month amid the drama. If strategy wins this will surely ignite a massive bull run for sure. First of all, one of the most important indicators of this bull market is the weekly 50-day moving average on the weekly charts, which has held the $20,000 to $120,000 Bitcoin run successfully. But last week, Bitcoin's price fell below the weekly 50 moving average, and if this week's candle doesn't close above the 50 moving average, it will confirm the breakdown from the 50 moving average. Lots of people might see this as a bear market indicator. But technically, we are still in a bullish market because Bitcoin is still making higher highs and higher lows in the macro look, till the price breaks below $75,500. If the price breaks below that, that means Bitcoin officially changed the market structure. Bitcoin might reach, if we see a market structure change, $50,000. That's the most bearish we can be on Bitcoin. The next 60 days in crypto will be critical. If you want to know what's actually happening before everyone else, hit that subscribe button.